course, lots to ponder as we go into the weekend. We have commodities and China. China inflation numbers coming out tomorrow, and some fears that they could raise interest rates following that inflation reading. What would that do to commodities and in turn to our markets, Asief?
I think that the inflation number is most likely priced into markets already. If inflation comes in higher than expected, you would anyway expect the Chinese government to possibly raise interest rates, or maybe even raise the deposit requirements for banks and cool down the economy. But that has been talked about, and people, investors know about it. So I don't think it's going to have a major impact on commodity prices. The Chinese government is obviously concerned about inflation because it might cause social unrest. And what they've done already, they've implemented food price controls. That would dampen inflation expectations possibly. But nevertheless, the Chinese government will do whatever they can to try and contain inflation and try and keep economic growth going in China. So I'm not too worried about commodity prices falling, but on balance, I would still be cautious just in case that happens.
Well, we're looking at those commodity prices. We had gold hitting a new all-time high this week. We had copper hitting an all-time high. Iron ore also looking good. Is that reflecting in our resources stocks on the JSE at this stage? Because although we've seen those commodity prices come back a bit, they are still looking very strong. Are we seeing that in the resources stocks like BHP, Billiton, Anglo American?
Yeah, I think there's a lot of skepticism that these commodity prices, because they're at an all-time high, it's unsustainable and it will have to come back there. There's a lot of investors in South Africa that's underweight resources stocks. However, if you look at the resource multiples on a forward basis, you're expecting earnings to grow in this current year by about 28%. That will bring forward multiples down to about 10 or 11 times, or maybe 12 times earnings. So on that basis, I think not all the good news in terms of higher commodity prices has been priced into the market. So going forward, the key is really, what's your view on commodity prices? Can it stay at current levels or not, or will it fall? My view is, at best, probably at worst, it could stay at current levels because of the Chinese and Indian demand, and that will be supported by greater urbanization, both in China and India, in terms of additional demand for durables, and that will support commodity prices. So I'm not too concerned about it. What I'm more concerned in the near term is the strengthening of the South African rand. And that's a bit of a concern in the sense that it will hit commodity prices or rand-hedged shares because of the stronger rand. Because of the rand that initially weakened when we had the most recent rate cut, I won't be surprised if the Reserve Bank at its next NPC meeting puts through another 0.5% cut just to try and weaken the rand again.
So we have Anglo American trading 331 Rand this afternoon, BHP Billiton 267 Rand 50. Much more upside in those share prices. Do you think investors have missed out on the most recent rally in resources stocks?
I think there is a little bit of upside, provided one has a view that commodity prices will stay at current levels. And the other more important thing is if the rand depreciates over the next 12 months. We will be of the view that the rand is, on a PPP basis, currently overvalued by about 20%, and also the interest rate differentials between developed markets and South African markets has narrowed. Another interest rate cut in South Africa, 0.5% to 1%, would narrow that gap even further, and that will encourage the depreciation of the rand, and that should help commodity stocks over the next year or so. But it's not a certainty, so I'm actually, in a sense, cautiously optimistic about resources shares.
How about the overall market? Because many fund managers we speak to say the big shares, particularly the top 40 type shares, are looking a bit pricey at this stage. Is that your view as well?
No, and the reason why I'm saying that's not my view is that there's an overwhelming consensus in South Africa from most fund managers that the market is expensive, they're cautious and all of those. And bull markets are generally built on a wall of worry. Globally also, you'll find fund managers also being cautious. They believe markets are a bit too expensive. And because of that, the marginal seller has already sold his or her equities. And because they've already done that, you're not going to get this overflow of stock coming onto the market. So I'm of the view that with a potential weakening rand, and also that the market is already priced in a lot of bad news, there's a lot of bearish sentiment out there, the market potentially could surprise on the upside. But in light of that, I'm still a bit, as I would call it, cautiously optimistic on the market as a whole. The PE on our market on a forward basis is 11 times, or say 12 times at worst. And that's not expensive in terms of, in historic terms. Also, interest rates are at a historic low, both locally and internationally. Investors will be forced to move from, less risky assets to more risky assets to try and get this additional yield. And I don't think the market is overly expensive. In my view, it's more fairly priced to the cheap side.
Outside of the resources space, where are you seeing value in the markets at the moment?
The retailers are a bit expensive, but what I would consider is the food producers, companies like Astral, Rainbow, Tiger Brands, AVI, companies that produce to sell to retailers. And the reason why I say that, if I use the example of the chicken producers, currently there's a little bit of a shortage of chicken in the market for the festive season, and normally volumes spike around this time of the year, and they have a bit better pricing power. So whatever, let's say they increase their price by R1 a kilogram per chicken, or even less, let's say half 50 cents per kilogram. All of that flows to the bottom line, so they've got a good gearing impact on the bottom line, and profits could increase significantly. Less so with, let's say, Tiger Brands and AVI, but as consumers have more to spend, if you look at higher net worth consumers who have, let's say, a mortgage of R1 million, they would have now saved on a 6.5% rate cut, R4,500 per month. And that they might not spend immediately, but as time goes on, they would have those additional resources to start spending, and that should be good for consumer demand going forward. So the food producers is an area that I would look at and as a potential investment opportunity.